Hey there, community bankers. Welcome back to the Correspondent podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Caplinger, marketing specialist for ICBB. So much has happened politically and economically in 2025, and perhaps especially in the second quarter. So I sat down to discuss some of these issues with Scott Kimel from our partners at FNBB Capital Markets and our CFO, Chris Dew. How are you guys doing today?
Doing great. Thanks for asking.
Doing great, thank you.
All right. Well, I'm glad to hear that. Scott, I'll kick right off and start with you. How did financial markets perform in Q2, and what were some of the biggest drivers behind these trends? Which I know we'll get into some more specifics as we go along, but just a general overview. How are we looking?
Well, it's obviously a very, very fluid time right now, and most of the markets are extremely volatile. And the volatility, as opposed to the normal times where it ebbs and flows fairly slowly, right now we're in a period where the world is changing day by day, if not minute by minute. A lot of that still goes back since February to the tariff talk. And whether they're on again, off again, the dates are being pushed back, the levels of tariffs are being changed. And now I think one of the things that's disturbing the market a little bit is we're starting to see tariffs imposed, not necessarily for trade related reasons, but for political reasons, like we've seen come out of Brazil of late. And so now the financial markets are getting roiled by the fact that economic power is being exerted, not strictly for economic reasons, but also for political reasons globally. The stock market has had a very good run, but the canary in the coal mine with that is, if you analyze it, most of the stock market run up is fairly heavily concentrated in very small sectors. So we're not seeing the breadth of gains that we typically see in a bull market. One analysis that I looked at showed the comparison of stocks that were hitting 52-week highs versus 52-week lows in rising market environments, and the ratio is very, very small right now. So we're seeing a few stocks, and more importantly, a few sectors, AI and things like in technology and defense, really driving this run up. As far as yields go, we're just kind of all over the place. We're still seeing a steepening of the yield curve, regardless of what Fed funds futures are telling us, and the political pressure that's being exerted on Chairman Powell to lower the target rate. Since the beginning of the year, the 2-year is down almost 40 basis points, which does reflect the global market's assessment that short-term rates will probably need to come down or be coming down, whether they need to or not. But the long end of the curve is up almost 25 to 30 basis points, which again underscores the sentiment that if the short-term rates come down or come down too fast, that's going to stoke longer-term inflation throughout the economy. It is interesting to note that both Germany and Japan, which are kind of our two most closely related interest rate partners in terms of stability or viewed as safe havens, their long end of their curves are both steepened dramatically as well. So there is a global concern about inflation. The one thing I would say, again, and you've heard me say it ad nauseum, is, Fed funds are an interest rate. It's the overnight rate, but it is not interest rates to banks. The yield curve is interest rates to banks. And if we see the short end come down and the 10-year actually go up or the curve steepen, just in terms of housing, that will actually slow housing down because it will make borrowing even more expensive for mortgage applicants. So it's very, very interesting times, to say the least. And to provide any sort of forward-looking guidance would be disingenuous on my part, other than to say Every morning we wake up and we'll see what the day holds.
Right. Yeah, that couldn't be more true. We were having a conversation just a few minutes ago before we started recording, about, what's been happening today, Trump being in this well-documented feud with Jerome Powell and, threatening to fire him and then decided he wasn't, and that kind of back and forth uncertainty. Can you speak a little bit to what that has done to markets and if there is anything at all you um, could see for that going forward?
Well, it's got the market very, very concerned because again, most mainstream and even center left and center right market watchers believe that when you look at the inflation numbers and you look at the data coming in, we still are in a pretty sweet spot right now. It's not really going solid one way or the other. When you look at the Fed's dual mandate, we're still basically at what used to be considered full employment. So they're fulfilling that part of their mandate. Interest rates are still historically pretty low when you talk to our parents and things like that. So, it's not a bad spot, and to be bent on driving the short end down, it really doesn't strike a lot of people as making a lot of sense. And so, one of the things that in just very, very candid terms we've seen is you cannot bully or manipulate the global market politically. The market is a risk assessment vehicle. And just like I mentioned earlier with the steepening of the curve, one of the things that Bloomberg has been reporting on fairly significantly of late is there are a increasing number of short positions being taken on long-term options on the U.S. Treasury. So what that means in plain speak is there are more and more people around the world, not just in Birmingham, Alabama, or Frankfort, Kentucky, that are betting that current policy and the current direction of the tariffs and monetary policy are going to cause longer term interest rates to increase. And just as a point of interest, that point right now, this afternoon, the 30-year Treasury, after breaching back above 5% last week, hit 5.06 during the half hour of turmoil this morning when there was rumors of Fed Chairman Powell maybe being ousted. But people, these large block trades, as they call them, are being placed at 5.30, 5.3%. So there is a growing course of financial investors out there, probably sovereign governments, a wide range, not just community banks, that really are starting to say, okay, we're going to start placing bets that this thing could go south. And even if the short end does come down through monetary policy that the Fed does control, the world's market controls everything outside of that, and increasingly bets are being made that that's going to push longer term borrowing costs, i.e. inflation risk, higher.
I think an important thing to add to that is a lot of the pressure on Fed Chair Powell related to dropping interest rates. While some of it is related to, fueling the economy, a lot of the pressure on it is actually in regards to the level of the deficit and the debt that we carry at the federal level, and trying to bring that down. And what Scott just alluded to is one of the things that I think some people don't understand is that Fed Chair Powell can slash the Fed funds rate all he wants. And while that will pull down the short-term borrowing cost on behalf of the Fed, it is not going to impact the long-term borrowing costs on behalf of the Fed. And the idea that we can replace all of that debt on the short end of the curve is absurd. And so while I can understand some of the push and the pressure against him, it's somewhat misguided, because the two things that I know for a fact it will do, or I believe for a fact it will do, is it's more likely than not going to trigger inflation, and it's going to have an upward push in regards to the long-term rates, which will kind of basically undo any good that it does do with those two things.
Right, absolutely. And I think that's important to uh, keep in mind as well. But speaking of, recent policy and its impact on community banks, the kind of controversial budget reconciliation that just passed included some tax changes for banks that the ICBA has advocated for. And I'd like to break down some of these with you guys if you're willing to do that. One of them being an Acre Act policy to make 25% of interest income on agriculture and ranch real estate loans exempt from federal taxation, which will bring interest rate relief for farmers and ranchers. So let's break that down, what that means for our community banks, especially our agriculture lenders.
So I'll kind of share my thoughts on that, but I'm going to put the precursor out there. I'm not a tax advisor. Please do not take anything I say as tax advice. And the number one advice I can give you on all these things that we're going to discuss is make sure you talk with your tax team, your tax advisory team, for a couple of different things. Number one, to make sure that you're applying all of this correctly. And number two, that you're accounting for it correctly so that you're actually getting full credit. So to get into the Acre side of things, the biggest thing from the community bank standpoint is the competitive edge that this gives the community banks against the farm credits of the world. So for years, we have fought with the fact that farm credit gets preferential tax treatment. They get to package and resell these, their deals. So they're going out into the open market. So they're selling at these market rates versus, really trying to generate the kind of returns that a traditional community bank will, things of that nature. So this levels that playing field. If you are a heavy agricultural market, you definitely need to be digging into this with your tax advisor, because I do think this will give you the ability to reduce, you effectively get to start treating some of your agricultural lending the same way you treat your municipal lending. So you get to tax affect that actual rate, and it will make you more competitive. The other side to that is, while it can make you a little bit more competitive from the rate side of things, one of the biggest things is the structural side, the term side. Farm credit has always been willing, because they package and resell, they've been willing to stretch out the terms substantially. So where a typical, community bank is not going to extend out past, maybe some are willing to go 10 years on their agricultural lending. Most cap it somewhere in the 5 to 7 range. Farm credit's still going out for 30 years. So you're still going to have to figure out a way to structure these deals, even with the improved pricing, so you can be competitive. But it definitely gives a big leg up, and it is something that you need to be digging into with your lenders as well as with your tax advisors.
Right. And I'm always glad to hear of, anything from any side of the aisle that gives our community banks a little bit of an edge against any of the many, many forces that they are competing against, which seem to increase in number pretty much every day. So another kind of advantage for community banks coming out of this set of policies is making the Section 199A deduction permanent, that supports Subchapter S community banks and other pass-through businesses. So what does that look like for our community banks?
So there's something that's already been in place. So it's not like a huge set. Whereas the Acre was something that it's new, and it's going to give us a new leg up. This is an extension of something. But one thing I'll talk about on this that I think banks need to be thinking of, especially for Subchapter S, where you basically have to dividend out, not just standard dividends, but you also have to dividend out the tax responsibility of your owners on an annual basis. The institution of this, because it was temporary, most banks did not adjust their dividends to reflect the fact that now their actual stockholders are not having to pay the full amount in regards to the taxes. They get that adjustment. So I do think this is a tool that could potentially be used on the bank's front if you're in a position where you're trying to kind of manage and stabilize some of that capital position. You should be able to make a bit of an adjustment in regards to the tax portion of your dividends as a result of this. I'm not saying that that's something that you should do consistently, but when you're in those positions where you need to be managing that capital position, it does give you the ability to tweak it a little bit from where you've handled it in the past. And I've spoken to a couple of Subchapter S banks over the last couple of years about whether or not they contemplated that. kind of got the eye roll of, well, my shareholders aren't going to want that. And it's like, yeah, I'm not saying that you adjust the dividend piece of your dividend. It's the tax piece of your dividend that you potentially have the ability to flex. But that will depend very heavily on who your shareholders are. So again, that's one of those situations where you've got to talk to your tax advisors and understand at least the larger shareholders that you have and how that would impact them. But if it allows you to reduce some of that tax-based dividend, that should be a real capital benefit for the banks.
Right. And that makes sense. So I'm going to move on now to kind of the lending side of things. Over the past quarter, what have you seen in terms of lending trends that have emerged? Are we seeing some growth or a contraction, maybe shifts in loan demand? I know that the inflation that's kind of been expected to increase a little bit from different tariff announcements and related things has really just kind of caught up with us. So are we seeing that affect lending at all, or what does that look like?
So it's been kind of there's a couple different storylines that are embedded there. I'll start off on the tariffs. Well, actually, I'll start off by saying, remember, I'm not technically the lender, but I'm setting in for them today. So we've seen a couple of different things on the tariff side. We haven't really seen much impacting the commercial lending side of things yet. Big, huge, flashing bold letters yet. There's conversations around it. We have those conversations in regards to our actual loan committees. And we know that our banks that we sub out with, they're having those conversations as to, well, how should we consider the impacts of this, but haven't started seeing it tremendously impact yet. However, we are starting to see some of the shifts in regards to the risk profiles and the risk acceptance levels on the sub-participant side. So we're seeing certain industries. I think we talked a little bit about this last quarter. We're seeing certain industries that some banks don't want to participate in, or if they're going to participate, they want a lot more back-end protection. So we're starting to see a little bit of a tightening of the credit standards. Thus far, we haven't had a real issue placing loan opportunities, but we are having a few more banks say no thank you to things if it's not coming in with really strong LTVs, debt service coverage. We have looked at a couple of things where the guarantor structure was, I guess I'd say, kind of outside of the norm, where it's 100% guarantee by all owners. That has scared some people off. So we're starting to see a little more of that, awareness in regards to the credit risk, which I think is, we'll get to this in a minute about things to do in the future. That's actually really important it's the right time to be doing it if you're ever going to do it. And we are seeing some of that. But we also continue to see growth. The opportunity still exists. In the past quarter, we've seen numerous opportunities. We continue to see opportunities in commercial development, which, to some degree surprised me. I expected by now we might start to see a little bit of a pullback on that because we haven't seen the impact, in regards to falling rates. And we're starting to see a little bit of a slowdown even on the residential development side. So a lot of times commercial will kind of ebb and flow with it, even if it is a little bit after. But we haven't seen that slowdown. Those opportunities are still coming up. We continue to see C&I opportunities with organizations that are expanding and growing. We continue to see some deals happening where there are buys and sales that are going on. So overall, we're still seeing good volume, good flow, but we are starting to see a little bit of the increased credit awareness and kind of tightening of the credit standards. It's again, I know we talked about it last quarter. We started to see it then, and it's almost like it's happening in these little tiny increments. If you go way back when to the financial crisis, you saw everybody basically go into lockdown kind of overnight. This one seems a little different, where everybody's kind of taking these baby steps towards tightening down their credit. So they'll be interested in a deal on, the first of the month, and by the end of the month, they're kind of, they're starting to pull back on the next deal that looks exactly the same because it's got just a little tiny bit of hair attached to it. So we are starting to see that trend.
And I would just corroborate Chris's assessment because, my barometer is basically tied to liquidity. And, banks right now are still reporting to me that loan demand is not torrid, but it's strong. They go through little ebbs and flows, but on the aggregate, I still hear that loan demand is good, and any excess liquidity that they've got loan opportunities to put them in, irrespective of Chris's assessment of credit. So I think the opportunities are out there. It's just a matter of, in a changing environment, where's that red line that keeps moving back and forth as far as the deals that they want to do.
Mm-hmm.
Right. And I'm glad to hear that, loan demand is still fairly strong and still pretty consistent. And, hopefully we see that continue. Scott, I'm glad that you mentioned liquidity because that was my next question. In prior to my understanding is, prior to like 2022, 2023, banks were all about loans, get more loans. And then, starting then it was like, oh no, we need deposits. We need some more liquidity. And there was a little bit of a, hate to use the C word, but liquidity crisis. So how's that looking, at this point? What challenges have community banks faced in terms of their liquidity and their deposits?
Well, deposits are still the challenge, obviously, in terms of that aspect of liquidity. But in terms of the crisis word that you used, banks are definitely breathing much easier right now. And again, the problem, not to rehash the past, but the problem really came from the fact that coming out of COVID, that the federal government just absolutely inundated the globe with liquidity. That liquidity went into very low yielding assets, not just community banks, but around the world. And those assets basically became buried because of their market values. And then coming out, the Fed raised rates 500 some odd points in a year, and so everybody was just buried. And we're actually starting to see some of that nuclear waste decaying away now, just to put it very bluntly. And so there is a palpable reprieve that's going on, not because deposit growth is necessarily growing, but because a lot of these assets, because Fed funds, are still at 4.5 or whatever, are even repricing 400 basis points when you wake up the next morning because it's matured. So that is a good news event after several years of bad news events. And that bad news event was basically being the fact that banks were paralyzed.
Yeah. I'll also add in there, as far as the bank liquidity levels, and this would speak to deposits as well. Scott spoke early on about the volatility in the market, which we all know. We've been talking about volatility now for, it seems like, way too long. But that volatility plays into the liquidity side as well. So, of course, being a correspondent bank, we see a lot of the excess funds that banks hold. And whenever we see those flux, we reach out to ask what's going on. And so if you go back to April, whenever, the actual initial tariff announcements were kind of solidified, and then you hit the pause button and fast forward to today. But when that initially happened, there was a major influx of liquidity into a lot of community banks. And when you start digging in, it was a somewhat predictable event because it's the cash hoard. So whenever there's a whole lot of uncertainty within the markets and within the overall economy, the people who have the ability to quickly gather and hoard cash do so. And what we've seen since then is we have seen a little bit of that pullback out. But I'll tell you right now, the excess cash that's on the balance sheets at banks today is still higher than it was at the end of last year. It's lower than it was, say, end of March through sometime in the middle of April. It has pulled back, but it's still elevated. So they're still holding on to some of that excess liquidity. And it's a combination of, I think, the banks probably making some good decisions in regards to preparedness, but it also is reflective of their overall deposit base, where they're holding on to excess funds because they've got some concerns of their own, whether it's positioning to be somebody that can take advantage of an opportunity, or somebody just remembering that cash is king and being prepared for what may come.
Yeah, in a real world examples I hear day after day, of varying magnitudes, banks telling me, we always like to keep 5 million in funds, but right now we're more comfortable with 9.
Yes.
And for no other reason than Chris's point, everybody's building a little wider shoulders on the side of their roads now, in terms of risk profiles. And I think it comes down to what I always call the sleep at night factor. They're willing to give up fill in the blank basis points for a better night's sleep. And I totally agree with it.
Yes. Yep.
Right. And that makes a lot of sense. And I'm glad that you alluded to preparedness. And we've talked quite a bit in this podcast and the last about, some of the risks and some of the uncertainty and volatility. We were joking earlier, if we started a drinking game every time, we said uncertainty or volatility, we would not be able to get through this podcast. But with that in mind, what are, we talked through some of the risk factors that community banks have been facing and will continue to face, and how can they be preparing to face those as we head into Q3 and beyond, even into the end of the year?
So from my perspective, a big part of it, and I've had this conversation with several banks. I also ran into some regulators and had a conversation with them about it, is, we all learned some very valuable lessons back in 2008 through the financial crisis in regards to understanding where our risk lies within our, especially within our loan portfolio, but really within our whole balance sheet. I think some of us have probably gotten a little bit complacent with that in the last few years, and which is understandable. But I think right now is the time to be dusting off the things that we learned back then and digging back into our balance sheets very deeply to understand where our risks reside, and doing everything we can to try to understand and mitigate those. Because right now, as we sit here today, I'm not trying to be the Debbie Downer or the person saying, the end is coming. I'm not saying that at all. What I am saying is, because of all, I'll say it again, the uncertainty and the volatility that we've been experiencing, these things don't typically happen whenever you don't see some type of event that creates unforeseen risk on the back end to kind of wash it out. So those risks exist today as much as they have in the past, and probably more so. And so I've been recommending to folks to really dig into your balance sheet, especially your loan portfolio, and identify where you have those concentrations, where you have elevated levels of risk. I had a conversation with somebody that, they said, I'm not too worried about commercial real estate. I don't do commercial real estate. And I just straight up asked them, okay, well, what's your HELOC portfolio look like? Well, yeah, I've got plenty of HELOCs, but people never draw on them. I said, okay, what's your utilization today compared to what it was a year ago? He said, well, I don't know. I said, well, you need to know. You need to understand that. You need to be looking at the things that you're not looking at to understand where that risk is. If you pull your HELOC portfolio and realize that utilization has increased by 15% over 12 months, why? Now, I've got a guess as to why, and Madison and Scott have heard it. I do believe that right now the consumers are they're hanging on by a thin thread. I mean, if you just look at the numbers in the market, you can see that the consumer debt load is at the highest level it's ever been in history. The acceleration rate is one of the highest it's ever been in history. And people continue to spend. And we're all saying, hey, the economy's good. People are still spending. They're spending borrowed money. And at some point in time, they're going to max out that credit card and they're going to come to your bank and draw on their HELOC. We also know that the housing market is starting to soften a little bit. It's not going backwards, but it is slowing and softening. Well, if you've got a higher utilization rate on your HELOC portfolio and a softer real estate market to protect you in regards to your actual collateral, you have an elevated level of risk. No, you're not exposed to office space in the CRE world. No, you're not exposed to lodging in the CRE world, but you are exposed to that consumer in an area where you think it's relatively risk-free. So I think looking at, and I'm just picking on that one particular area because it's one that a lot of community banks are very heavily invested in. And I'm not saying there's like crazy risk, but you need to know that risk. And you do the same thing on your CRE portfolio. What is your exposure to consumer anchor strip centers, where I've got strip center debt out there, and I'm like, hey, these guys are strong as new rope, and they've got a big lots and the nicest Mexican restaurant in town in these strip centers. And I do pick on that because it's the most common strip center. But look at that and understand where is your exposure there. Because as those entities start to see a little bit of reduction in consumer spending, it doesn't take much for those lease payments to start to slow down. And when the lease payments slow down, your payments slow down. So I think just understanding that risk and positioning yourself to be able to mitigate that, I think is very important right now. I do believe there's going to be some good opportunities that come out of whatever we see unfold. I think there will be really good opportunities. I think if you're doing the work today to measure and mitigate any of the risks you can, you better position yourself to take advantage of those opportunities on the back end, as opposed to kind of being, caught whenever everything starts to unfold a little bit.
Yeah, just a couple of comments. I think what Chris said is about the preparedness, what you're really preparing for, to his point, when he says use the word opportunities, is being agile, that when those opportunities present themselves, you're not last to the party when there's new opportunities. And the other thing, which is a much broader overview of thought, is, I always talk about the great scene from the movie The Firm, where they're talking about whether Tom Cruise is trustworthy, and the one lawyer says there's nothing to be suspicious about. And to Chris's point about the guy saying he's not sure about the HELOCs, it's your job to be suspicious when there's nothing to be suspicious about. And yes. I think that is just a great overriding theme these days, because we really have been in the halcyon days of credit for the past several years. Nobody's had, real credit issues other than isolated instances. And I totally concur that bankers need to now be suspicious right at the time that there's nothing to be suspicious about.
Yeah, absolutely.
Right. I think that's excellent advice heading into Q3. And Chris, you kind of alluded to this. I was going to give you the chance to kind of soften the Debbie Downer part a little bit. You alluded to, seeing opportunities coming out of, whatever it is that unfold. And as we've learned, I think over the past 5 years, it could be literally anything.
Mm-hmm.
But how can community banks kind of position themselves to take advantage of those opportunities? It's, preparedness. Is that the whole secret?
That it is. It really is. But again, it goes beyond just investigating what's in your portfolios. We talked last time about making sure you've right-sized your balance sheet, reviewed where you are, what your levels are. Are you prepared for growth? What kind of direction are you headed? So it's a good time to, again, review your capital position and, determine whether or not there's anything to shore up there, review that liquidity position, go back through everything and kind of say, do I have enough dry powder to either A, weather the storm, or B, be the one to pick up the pieces as somebody else is trying to weather the storm. And that's when I say good opportunities, when you go through these economic cycles, ups, downs, whatever, there's always some degree of winners and losers. And to me, the importance of the preparedness is I want to be the guy who gets to take advantage of, and I don't want to take advantage of somebody else's, poor situation, but I want to be there to pick up the pieces and be able to collect some of that, as opposed to being stuck in that situation. So having a good liquidity position right now, I think, is very important. And most banks, it seems, are doing that. Having a good capital position is something I think is very important. And generally, the market's in a really good position. The industry, is in a very good position market wide. And then, understanding that risk in that loan portfolio. The other thing that I think, and this will happen, and it's funny because this is both a risk and an opportunity. So I'm going to throw it out there. I remember in 2008, I don't know what they actually called it, but in 2008, the large banks went through what at the bank I was at, we coined the review and remove process. So they basically go through their loan portfolio. They identify the projects or the particular industries, is what they were really known for, where they thought there was this elevated risk for whatever reason. And they did everything in their power to, they reviewed the credit and then they removed it from the bank. They pushed it off the books. Now, that is a risk, because those people are going to walk into your bank and they're going to sell you on how great of a deal this is. And they're going to tell you how awful you name it. I'm not going to name them, but they're going to name, one of the top 10 national banks in the country and how horrible they are at customer service. And they want to find a better partner, and they're going to sell you on taking this deal. So it's a risk because there's a reason why those banks pushed them out. But quite often there is an opportunity because there are some good relationships that you can build out of that. A lot of these people get pushed out of a bank simply because of the industry they're in. It doesn't change the fact that as a guarantor, they are incredibly strong. And if you can be the one there to pull that deal back in, keep it alive, and create that relationship, it will pay dividends for a lifetime. The flip side is if you don't do really strong underwriting, as I said, there is a reason why it got pushed out. So if you don't do your due diligence on the front end, you can be the one left holding the wheel when the car hits the wall. So it's going to create both. But if you're prepared for it and you've got the the ability to kind of take that on, there's some good opportunities embedded in that.
Absolutely. And I think that's a really good, hopeful place to end what has otherwise been an uncertain and volatile podcast. Chris, Scott, thank you guys so much for coming on and discussing some of these heavier topics with me. I think our community banks will get a lot out of your respective expertise.
My pleasure.
Yeah, thank you very much for letting me be a part of it. Enjoyed it.
Thank you for listening to the Correspondent Podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.